Hi, my name is Grace Cisna. I'm the CPA on staff with ProjectionHub, and today I wanted to take a little time to walk you through our retail and e-commerce template. This financial projection template is great for developing financial projections for a business that has both brick and mortar locations and a significant online e-commerce revenue line. So with this template, you will enter information about your business on these light blue input tabs, and then the projections will populate for you. So you'll have a projected income statement, cash flow statement, and balance sheet for 5 years, and then those same 5 years broken into the individual months. So let's start on the input assumptions tab, and I'll walk you through how to use the template and show you how it all populates out to the financial projections. So on this input assumptions tab, you will see light blue cells, and these are the cells where we want you to input data about your business. So there's already data in a lot of these areas, and that's just showing you how to fill out each section. It's not necessarily industry standard data or recommended data, it's just showing you how to fill out this template. So you can enter your business name here, projection start month. This annual inflation rate for operating expenses is going to be used on the input other expenses tab. You can enter investments, up to 3 different investments or rounds of investment here. You enter the name, the value of the investment, or the total cash received, and then the month of operation invested. This month 0 means that this cash is being invested before operations begin. It could be that you have some cash invested before operations begin and then have a second cash infusion and say the beginning of year 2 or month 13 of the model, in which case you would enter 13 there. Accounts receivable terms. So for the most part, you're probably receiving cash at the time that goods or services are provided to your customers. However, if you offer credit for your customers and let them pay you later, you can enter different accounts receivable terms here. So for example, you could have 80% paid at the time of receipt and 20% on net 30 payment. Inventory, you would enter here, and this is going to go on your balance sheet. So beginning inventory is going to be purchased, according to the financial statements, it's going to be purchased right before you begin operations. So that'll be a cash outflow. And then your inventory balance each month is going to be measured as a percentage of next month's sales. So that's a percentage of next month's cost of goods sold, or the amount of goods that you're selling. That way, your inventory values move as your revenue values increase. Fixed assets, you would enter here. We have a couple examples: leasehold improvements, furniture and fixtures, you enter their value. The life expectancy in years and the salvage cost helps us calculate your depreciation expense, which goes on your income statement. And then purchased during which month of operation, again, you see that 0 here, signifying that these items were purchased prior to operations beginning. You could also have additional items purchased. Perhaps you're planning for renovations in month 6. You would enter those with a month 6 here. You can enter up to 4 loans in this model. These could be things like mortgages, financing for any furniture and fixtures, small business loans, loans from family and friends. You would enter them here, the amount, the number of monthly payments, the interest rate, and the month payments will start on. And the model is going to do the rest of the work for you. So it's going to calculate your monthly payment, your interest expense, and the declining balance of your principal on that loan. Just note, month payments will begin. In this case, month 1 has been selected, and that means that the cash is going to be received prior to operations beginning. Let's say that you are planning to receive a loan in the middle of the year, and your first payment will be month 5. Well, the model is going to assume that you receive the cash in month 4. Next up is the input revenue tab. This is the bulk of the model here. This is going to help you project out your revenue for 5 years. So we start with customer acquisition for your brick and mortar store or stores. This could be more than one location. Just keep in mind, total store visitors is going to be your total for all locations if you have more than one location. So we're going to pull in your advertising budget, which you will enter on the input other expenses tab. We're going to look at the cost of acquiring a new visitor. And this could just be how much do you spend in advertising and how much does it take to bring in a new visitor here. So we have $10 as an example. A lot of times for brick and mortar stores, advertising doesn't pull in as many visitors. A lot of times your visitors are coming from organic Google searches or just people driving past the location. and stopping by. So we also have this line for organic visitors, or visitors that are not coming from advertising. They're either coming from Google searches or recommendations, or just, again, driving by and stopping in. So then we'll have the total store visitors for all locations here. We're going to pull that total store visitors down into the next section. So we're going to look now at brick and mortar revenue. So once we have your total customer visits during the month, we're going to look at what your customers are buying. So we enable you to have up to 9 different item categories, and you can actually add rows here if you need more than that. We don't recommend entering every single product that you sell. It's much easier to roughly categorize the products, perhaps by price or by type, by section. However you categorize them is probably going to work well for this model too. So then you look at an average price for that whole section. So maybe one of the items you sell is furniture. You could have furniture up here. And perhaps the average price of furniture is about $250. So that's what you would enter here. In addition to the price, that's the price to your customers, you have the cost to your business of each item. So perhaps you sell handmade mittens and you sell those for $18, but they cost about $6 to either purchase them from the person who makes them or for the yarn if you're making them yourselves. So you would enter the cost there of what it takes you to produce or purchase those mittens. And then here you're going to enter the average number of purchases per person per visit. And what this helps us calculate is the average spend per customer. So based on this chart here, which is just filled with generic data, the average customer is spending about $25 in the store. And that's because they're purchasing about this many things. So when we look at this first item here, item category 1 of a $100 item that you purchased or created for $30, the 0.1 purchases per person, that's 1/10. So we're assuming that 1 in every 10 customers is purchasing one of these items. So that's another way to look at it. And this item category 6 is 3/10. So 3 out of every 10 customers are purchasing one of these items. And if you add all those up, that means that each person is purchasing about 1.5 items. The gross margin, that just means the revenue minus the cost of goods sold. So for our mittens that we're selling for $18, $6 worth of yarn, our gross margin would be $12 in that case, and that would be 75%. So this is 70% here, essentially the amount that your revenue minus your cost of goods sold divided by your revenue. So we pull down that average cost, our average spend per customer here, enable you to enter a growth rate. So perhaps your prices will rise over time. Or another reason that this might rise is over time, customers purchase more goods per person. So we're starting out at 1.5, and this 5% could indicate that people are purchasing more items as well. The cost of goods sold per customer, that is also calculated from this chart up here. And that you can grow over time with this annual growth rate as well. Okay, now we repeat that same pattern almost exactly for the e-commerce revenue section. This time we use the online advertising budget. That's also coming from your other expenses tab. And now with online sales, advertising is usually more directly linked to your purchases. So in this case, you can enter your cost to acquire a new website purchase. The monthly purchases from paid ads is then calculated for you. And you can also have organic purchases, not from paid advertising. So again, this is coming from Google searches for the most part, or other methods of finding your business. This could be if you have social media pages that aren't costing you any money to run. This could also include purchases coming from those social media pages as well. So once we calculate out your total website purchases, we follow this exact same pattern. We look at what your customers are purchasing. One item that you might want to add here in the e-commerce sales section is shipping. If you are shipping to all of your customers, right now we have this set to 1 purchase per person per visit. So if you're charging for shipping, we're looking at every customer purchasing 1 shipping item for their sales or for their purchase here. So we left a little note for you down here. The average number of items purchased per person could include shipping. So in this case, we have 2.55 items per person, but 1 whole item is considered shipping. So actually your customers are purchasing 1.55 items and 1 unit of shipping for each purchase. So then we follow that same pattern. We look at the average spend per customer, annual growth rate, the average cost of goods sold per customer, the growth rate, and then we summarize those two items down here. So in-store revenue versus e-commerce revenue over time. Next, let's look at the input direct labor tab. So on this direct labor tab, you're going to calculate out your hourly position. So we look at the number of hours that your store is open each week. Opening and closing hours will be the hours right before you open and right after you close. That might include cleaning bathrooms, sweeping, reorganizing, restocking, those hours that you have employees there and they're getting paid. And you'll enter an average hourly rate and a transactions per hour per employee. So transactions per hour per employee has an inverse relationship with the number of employees that you need to hire. So if you have, if your employees can handle 100 transactions per hour, then you need far fewer employees than if your employees could only handle 5 transactions per hour. So this average employees per hour can move up and down with the number of transactions per hour per employee. But we do have a minimum number of employees. So if you have 2 hourly employees at all times, you'll see that 2 pop up here. And in this case, you never need more than 2 employees based on the transactions per hour. And those are coming from the input revenue tab. But if we say that each employee can only handle 2 transactions per hour, this number could increase over time. There we go. So if only 1 transaction per hour, you would need more employees. So in this case, you're unlikely to need more than your minimum here. This model will calculate your direct labor expense for you based on the average hourly rate, the number of hours per week. Now we can look at the input other expenses tab. So these are your other operating expenses that are not direct labor, that are not salaried employees. And we're also not talking about interest expense or depreciation expense because both of those items are already calculated for you. So in this tab, you will enter your different types of expenses. Note we have local and online advertising. Neither of those can be moved, but the rest of the items can be moved around, replaced, and you can enter new items in the blank rows down here. You'll pick a category. The only place that this category matters is on the investor dashboard tab, which we'll get to at the end. It's over here on the left. So what you'll do is you'll enter, for example, accounting services. Let's say you pay $100 per month. You'll enter that for the first 3 months individually, and that's so that you can incorporate any additional startup expenses. So it could be that your accountant charges $1,500 to get the books set up for your business, and then $100 every month thereafter. So that's why we break out the first 3 months. And then continue entering monthly expenses across the board, but this time it's going to use that monthly expense for the period stated. So this would be $100 per month for month 4, $100 in month 5, $100 in month 6, etc. And then it's jumping up to $103 in month 13, which is the beginning of year 2, and it'll be $103 in month 14, etc. Note this increase here. You can override that increase from 100 to 103 just by typing in this cell, but that increase is coming from our annual inflation rate for operating expenses right here on the input assumptions tab. That's one way to enter expenses. You can also enter expenses looking at a percentage of revenue. So you can say it's either fixed or it's a percentage of one of the types of revenue, total revenue or store revenue or e-commerce revenue. So if you have, for example, processing fees for all of your online sales, you may have an expense that is a percentage only of your e-commerce revenue. In this case, we entered credit card fees as an example, and this was going to be calculated as a percentage of total revenue. And these are the fees that you might pay, the processing fees you might pay to Visa or MasterCard, et cetera. So in this case, they're 3%. So any percentages you want to enter in this format, 0.03, as opposed to 3, which would be 300%. So that's how you can calculate expenses as a percentage of revenue as well. A lot of times those are going to be point of sale systems, online payment processing fees, credit card processing fees, all those things that happen with each transaction. You can enter an effective income tax rate down at the bottom here as well. Okay, the last input tab is the input salaries and owner draw tab. So here you would enter your salaried employees as shown. So if you have a manager, you'd enter their salary, an employer tax amount here in the US, that's often 7.65%. Benefits if applicable. Month started, month ending is always 60 unless it's sooner. So perhaps you plan to have somebody helping you for the first 12 months. Their month ending could be 12, but there's only 60 months in the model. So that'll be the last month for most of your employees. You can duplicate employees or create 5 or 6 of them if you'd like, just by changing the number in column I here. You can also give them an annual raise so that your salaries will increase over time. If you choose to pay yourself via salary, you could enter yourself here on the salary section. A lot of business owners would also pay themselves through owner draws or disbursements of cash. Sometimes we call those dividends as well. So if you plan to pay yourself out of the business that way, you'd enter it down here. All right, so those are all of our input tabs. So let's take a look at the output tabs. So this model is going to generate this at a glance tab, which has some really highly summarized financial data, some key ratios, and then some graphs and charts, which are ready to be put into a pitch deck. Then we look at the income statement summary. So this is all 5 years of the income statement. This is the statement most commonly requested by banks and investors. So if you're wondering what the bank or investors need, it's probably the income statement summary here. So on this, we pull in your 2 types of revenue, your store revenue and your e-commerce revenue from the input revenue tab. We pull in the cost of goods sold. Remember, that's the cost of, for example, yarn for mittens. So that direct materials is coming from the input revenue tab as well. The direct labor is coming from that input direct labor tab. That's all of your hourly employees. And then we take your total sales minus your cost of goods sold to get to a gross margin. Then we take this gross margin divided by total sales to get to our % gross margin. Then we take a look at operating expenses, and these operating expenses, all but the last 3, are coming from the input other expenses tab. So we looked at local advertising, for example, and note that's rising at 3% per year based on that inflation rate we set on the input assumptions tab. You'll note here credit card fees. This one is measured as a percentage of revenue. So this one increases over time as revenue increases. And then all these other items are just increasing with that inflation rate. Okay, salaries. This item is coming from the salaries and owner draw tab. So that is all of your salaried employees. Loan interest expense is calculated based on the loans you enter on the input assumptions tab. Note, loan interest expense is different than your actual loan payments. For the purpose of accounting, we don't consider the entire loan payment an expense. A portion of every payment goes towards paying back your principal. So that's a cash flow, but not an expense. So this is just the interest expense. We'll see the whole payment on the cash flow statement. Depreciation and amortization, this is coming again from the input assumptions tab. This is related to your fixed assets. So these items, as they depreciate, we book an expense on the income statement. Total operating expenses are summarized there. Our net profit is our gross margin minus our total operating expenses. And then we have our income tax expense, and that is just 20% of our net profit. You can see if your net profit is below 0, we calculate 0 income tax. Once it gets above 0, we calculate some income tax, and that's just following the rate established down here. And again, 20% is just a placeholder value. So you'll definitely want to talk to a local tax accountant to figure out what your tax burden might be. Net income then is the net profit minus the income tax to get to your total net income. EBITDA is your earnings before interest, taxes, depreciation, and amortization. And if that doesn't mean anything to you, that's all right. But if you're looking for it, it is there. Let's take a look at the cash flow summary. So the cash flow statement is very similar to the income statement, but for a couple different categories. Down here, we have the cash from financing and investing. So cash coming in from investments, from loans, cash going out towards fixed assets, and cash being paid on loans. Those items are all considered in this section here. So just as I promised, your total cash payments for your loans are on the cash flow statement. They're actually broken into 2 sections here. So cash paid on loan principal is the portion of your payments that goes towards decreasing your loan balance. And then cash paid for loan interest here up in the operating activities. And that is the portion of your loan payments that goes towards paying off the interest accrued on your loan. So the sum of these 2 items is actually your total loan payment. And you'll see that that is the same every year. We've got 23,475, and again, 23,479 down here. So, so that's the main difference between the cash flow statement. You'll also see on the cash flow statement, there is no depreciation expense. Depreciation is a non-cash expense. So instead of depreciation, you see cash paid for fixed assets here, which happens when you purchase the fixed assets. Where on the income statement, we sort of depreciate those over time. So your cash at the end of the period is going to be your starting balance in the first year of 0. You receive cash from sales, you can receive cash from loans, investments, etc. You pay cash for all of your expenses and for your loans and fixed assets. And that ends up with our cash at the end of the period, which is then pulled up to be the cash at the beginning of the period for the next year. And we repeat that same pattern. The balance sheet is here. It shows your assets, your cash and inventory, any fixed assets that you have, and then your loans, so your accounts payable, your long-term loans here. And then any amount of your assets that's not attributable to your loans is going to be your equity. So this retained earnings here is the cumulative equity that you've built in the business from your earnings. Note about our balance sheets, they always balance. That's one nice thing about purchasing a template versus trying to create financial projections on your own. Getting balance sheet to balance is very, very challenging. We have those same financial statements just in the month-to-month format here. You can see there's all 5 years here if you keep scrolling down. One thing I always like to point out to clients on the cash flow statement, this cash at the end of the period from month to month is one of the most important pieces of a financial projection. You want to make sure that your cash balance does not go negative. So in this case, this business is set. Their cash balance does not go negative. This will tell you if you're raising enough funds from investment and from loans to keep your business operating. So a lot of times you're not profitable for the first couple months. You can see here, this business in the middle of the first year has some negative cash flow moments here. And this could be due to increased expenses or decreased sales in the middle of the year. So you want to make sure that you've raised enough cash to sort of weather the storm of negative cash months, which are really common in startup businesses. So this is the place to check to make sure you're planning accordingly. The investor dashboard is the last tab we'll review. The investor dashboard is just for you or for potential investors to play with some different scenarios. So we've pulled in some of the major assumptions from the revenue model here, like in-store customers and their online customers and what they're spending, as well as your gross margins and some of your expenses as well. And you can play with those assumptions in the light blue up here. You'll see your original income statement, which is just a summary of the income statement summary. And then the income statement if you modify it using the assumptions in blue up here. So if you're looking at some different scenarios, you wanted to see, well, what if we only have half as many customers? This is a great place to sort of play around with that without having to change everything in your whole model every time you want to try a new scenario. So that was a brief overview of our retail and e-commerce template. If you have questions about this template, please reach out to us at support@ProjectionHub.com. We would be happy to answer your questions about the template. We know everything there is to know about it. I developed it personally, and I'm always happy to answer questions. In addition, if you like the template, but maybe you have additional revenue streams or you've got some funky expenses that are calculated in strange ways, we're always happy to modify these templates for you. And we can build in different assumptions, different models as well into this template and create exactly what you need for your business. In addition, maybe you love the template as is, but you don't have enough time to fill it out. We can fill it out for you as well. So don't hesitate to reach out to us at support@ProjectionHub.com, and we hope that this template is really helpful for you.